Hi guys, this is Arma Pesanovic from ForexCT. Today we'll be going through bonds and how to actually analyze these yields and the prices to gauge the sentiment of the market. So pretty much finding out how the market's feeling, if there's a risk on attitude or there's a risk off attitude. And we can use this to obviously trade directions of currencies, commodities, indices, and all the other asset classes such as equities as well. So hopefully everyone's well today. Before we start, Forex does obviously involve a substantial risk in trading your capital. This is obviously managed by stop losses or whichever risk strategy that you're using. The following education session is just general advice. It's not personal, so keep that in mind throughout the webinar. And let's get started. So firstly, what are bonds? So in simple terms, a bond is something that, for example, if you came up to, well, if I started, say, I was a business and I needed money to fund something like a project, I would sell you a bond. I would say, let's say I had a face value of $100. You would give me $100. And on that bond, there would be, for example, a 2% interest per year, and it will expire in 10 years. So you'd be giving me $100. I'll be using that money to invest in something to get a higher return. And then every single year, I'll be giving you 2% of that face value until the 10 years expires, and then I'll give you back your $100. So typically, companies or governments do this when they're low on funding. They want to start new projects. They want the funds now. They sell bonds. They use the funds for their projects. They get the return, let's say if it's a company, and they pay back the investors. It's similar like a company going public with shares. They're selling shares. They're getting money for the shares. They're investing that money and obviously reinvesting to the business and growing the business. So, that's probably why in general people actually do sell bonds. So in this whole webinar, we'll focus on just the 10-year government bonds, also known as the treasury bonds. This is a good gauge of sentiment in the market, and we can use this for our trading. And it's quite interesting as well how it all works. And like I said, definitely it's going to add some probability to your trading, and it may even increase the win rate of your trades. So we did talk about safe havens a couple of weeks ago. Safe havens are basically places where investors put their money in when they start to panic or they want some stable and safe returns. Bonds are considered the most safest investment, especially government ones, because they're backed by the government guarantees, because if they wanted to, they can always print money to pay back the bonds. So they are considered the safest investment. Of course, with low risk, there's low return. That's why the interest that you get is so low. So at the moment, for Australia, the 10-year, last time I checked, it was around 2.6% per annum. And again, very safe return. So in events that the market panic, let's say, for example, recently North Korea sent out threats of nuclear threat. When people start to panic, they put funds into safe havens. So for example, bonds. So the reason why they're doing that is they want to protect their investments. And when they do that, we can see that flow-on effect. So we can actually look for that and place trades accordingly. Same thing goes with, for example, Brexit last year. Other safe havens like gold, they would have rallied high. Another example is the Trump election. Another example is the French elections, the round one recently. And a good one to be looking at is this coming week's election as well. That's round two. So with bond yields, you can see at the bottom of the chart, that's a US 10-year Treasury bond. At the moment, it's yielding, so a return of 2.3% per annum. So you're getting 2.3% every single year. And at the end of the 10 years, you're getting back your money that you paid for that bond. And what the government's doing with that money is they're investing in infrastructure or whatever they're doing with the funds, wherever it's allocated to. So the bond yields, they are inversely correlated with the price. So if bond yields are going down, that means that bond prices are going up. So if we see that bond yields go down, we know that people are buying bonds. And when people buy bonds, naturally it's a safe haven flow. So we know that people are starting to panic and go into more safer investments. So naturally, other safe havens will also increase, like gold and Japanese yen, which will go through just in about 2 minutes' time to how we can put that all together. So because they're inversely correlated, it's easy to gauge what the market's thinking. So bond yields go down, prices go up. If bond yields go up, prices go down. And that means people are selling bonds. So people are taking out of those safe haven flows and going to more risky assets. So another important thing to look at when you're looking at bonds is the cash rates. to the central banks, because these ones move with the actual yield itself. So if cash rates rise, then the yield will also rise. And that's the same thing. It's rising, people are selling bonds. Interesting thing to note here as well, in times of GFC of 2008, you can see at the bottom, there was a lot of bond buying. And we can see that from 4%, it dropped all the way down to around 2.3%, and that's where it is at the moment. So it's pretty much all bonds across the board, Japanese bonds, the German bonds, they've been at historical lows for quite some time now. You can see since 2012 it's been ranging. They were at 4.5%. That's when the countries had high interest rates. We see now we're in a very interesting time at the moment with low cash rate and higher inflation in some countries, which really means that any fund sitting saving account, if you're earning less than whatever the inflation rate is, in Australia it's 2.1% year on year. Keep in mind that's obviously headline inflation. It includes volatile price items such as commodities. It really does mean you're losing your money's purchasing power if you're not earning more than that inflation. That's really interesting to note. That sort of environment we're trading in. It's very difficult, but also very interesting at the same time. So how we can put it all together, we know that the safe havens are gold, Japanese yen, and bonds. If we look at the charts, we look at all these asset classes, and we see that gold is going up, Japanese yen's going down, the Nikkei 225 is going down because it's in general inversely correlated with Japanese yen, and also the volatility is going higher and higher. This was a perfect example a couple of weeks ago with North Korea and also French elections. We know that people are starting to panic and put money in safe havens. And when that happens, safe havens increase. So for example, USD JPY, that fell quite a bit. It went down to 108 to new lows. So that could have been a great trade for a sell position. The Nikkei 225, if the Japanese yen's increasing, would have been a great trade for a sell position as well. We saw a significant drop as well on Nikkei 225. Same thing with gold. If safe havens are increasing, a good position would have been to be buying gold. And of course, with all trades, you want to diversify your risk by obviously investing in different asset classes. So commodities, bonds, equities, and currencies. So with the volatility index, you can find some volatility indexes on Google. Some are actually tracking the commodities, some are tracking Forex, but the main ones I found even Bloomberg use is the one that tracks the S&P 500, which is the US market. So really interesting to know these things, and that's something that a lot of traders look at before putting positions on and sort of gauging what the market's thinking. But keep in mind, of course, that as we go through these things each week by week, we'll be putting it all together at the very end. But it's just one more thing you can add to your own trading system, and so that we can get the obviously higher probability for your trades. So thank you for watching today. We appreciate your time. Make sure you check out the next webinars coming up because it's going to help you become a better trader. Thanks again.